Welcome to the Mint Funds and Market Update. I'm Kirsten Boldarin, Amplify Group CEO. If you can just please take a minute to note the disclaimer regarding this recording. So January was a positive month for equity markets, with global equities rallying almost 3% as US data showed inflation continuing to moderate and activity remains strong. In the US, this more positive data led to front-end rates declining and back-end rates increasing, causing bonds to fall. It already feels like a very long time ago, but in January, geopolitical tension escalated as the US removed the Venezuelan president and also threatened to impose further tariffs on Europe if they opposed Trump's plan to take over Greenland. This caused gold to continue to rally, and while the market in aggregate was up, we have seen a significant rotation in sectors and quite a lot of movement within the market. So just taking a look at data up to the 16th of February. So we've seen quite a significant move between sectors. So if you look at the data on the left-hand side, which takes you from January to the end of October, what we've seen is, we saw last year a significant rally in information technology and also communication services, bearing in mind that that communication services category includes some of those textile names such as Amazon and Tesla. But then moving towards the back end of last year, so the rotation really sort of kicked off October, November time, and we have now seen a material sell-off in technology stocks, and a lot of this has been driven by an industry perception that some of those technology names are likely to be threatened by the rise of artificial intelligence. So the main focal point for the technology sell-off has been software as a service or SaaS businesses. So these are some of the businesses which have been among the best market performers for the past 15 to 20 years. So the current market narrative is that the moats which these companies have around themselves will be significantly diminished by AI. A more local market example of this type of business is Xero. So these businesses are now trading at very cheap levels on a market relative basis. That doesn't necessarily tell us whether they're good value or not, but the sell-off has indeed felt pretty indiscriminate. And our perception is that many of those businesses will integrate AI into their product suite to drive efficiencies and profitability. And we also see some of the depth of the move in markets as symptomatic of market dynamic, which has come to bear quite significantly over the past 10, 15 years, which is really around passive and quant-based selling and the lack of active support that then steps in to halt some of that selling pressure. Now, of course, there is a lot that we still do not know regarding the integration and impact of AI on businesses. On the left there, we share some of the work from Michael Sembalist's 2026 Outlook piece, which is always worth a read. And in this piece in particular, he goes into considerable depth on AI. So the point of this piece is just really to show that back in 2025, MIT did a study and concluded that there had been limited AI disruption and that it had really been confined in the media and telecoms and professional services sectors. Wharton at the same time, around the same time, produced a paper as well, but their conclusions were quite different and highlighted a much more positive case for AI adoption amongst businesses. So here you have two highly respected institutions coming to vastly different conclusions, and hopefully that should make us all feel a little bit better about our own attempts to understand the integration of AI. In January, we wrote a piece about the adoption of electricity and the parallels with AI adoption of today, of which there are many. When electricity was invented, many factories initially merely replaced their steam engine, centralized steam engine, with electricity, and this didn't actually produce much in the way of productivity gains. The true productivity gains came about when electricity was really integrated into workflows, and base processes were re-engineered around electricity, and that was a much more transformative approach, which really then drove a lot of the productivity gains from electricity. The challenge with that is that it took time, and really the winners in that circumstance were those who actually had the balance sheets to invest in the re-engineering of their processes. So our perception is that, the strong companies who have the depth of resource and balance sheets to really integrate AI into their businesses are the ones who are likely to be the winners in that situation, as opposed to necessarily the smaller businesses, which are being perceived as, a significant threat to some of those software businesses currently. We will wait to see what happens. Moving on to New Zealand, we had a higher inflation print, which is not welcome news, and it certainly puts the Reserve Bank governor in a more challenged position. At least the glass half full aspect of it is that it is reflecting improving economic data, and we had PMI data come in well into expansionary territory, and hopefully that means that the strong Q3 GDP print was not a flash in the pan. The New Zealand dollar also rallied, something that we spoke about last month, and just highlighting how undervalued on a trade-weighted basis the New Zealand dollar was. And really that reflects the expectations of higher growth and obviously higher rates going forward. Whilst the inflation print was higher, inflation is expected to decline as food and fuel price growth should slow, but it feels as though inflation is likely to be stuck in that top half of the band, and will probably start to prompt rate expectations to continue to be elevated. Just some analysis from Westpac. They anticipate that the RBNZ will leave rates on hold until they get full confirmation of the economic recovery, with the expectation that rates are set to start rising in December. And that more rosy economic picture is also confirmed by something that we included quite regularly, which is the RBNZ nowcast, with forward-looking GDP expectations pointing to ongoing consistent growth, so confirming some of the other data that we have seen. I guess the only real concern is the impact that the upcoming election may have on the vibes, and just given the closeness of the polls and quite differing policy positions, that might create a bit of uncertainty. So it was a tough month for the diversified funds, just really on the back of that sell-off in technology-related equities. So the Diversified Income Fund fell over the month, really, as I say, driven by that equity component. A number of the technology stocks, exposed stocks, faced material declines, and this was also repeated in the Australasian component of the portfolio, with a number of higher growth Australian names facing a material sell-off. And similarly, the Diversified Growth Fund decline was driven by that equity component as well. Whilst there were a couple of brighter spots, such as Cisco and Novo Nordisk, the technology names again did most of the damage. So Shopify, despite reporting a beat on revenue, missed earnings per share expectations and was really punished also by falling into that broader concern, AI-related concern, and the impact on their software business, and ditto for SAP. As mentioned earlier, many of these software businesses are now trading at relative valuation levels that we have not seen for many years. And we certainly see significant opportunity in some of those names, and anticipate that the sell-off is really producing opportunities for us. Thank you for listening, and as always, please get in touch should you have any further questions.